Welcome to a new edition of a chat with Daman Asset Management team. In this edition, we will be presenting our views for the month of April.
The overall macro backdrop is challenging for EM fixed income given the lower growth and higher inflation forecast revisions due to the impact of 1, the Russia-Ukraine war, 2, a more front-loaded Fed hiking cycle leading to tightening financial conditions, and 3, China COVID restrictions fragilizing further the international supply chain as we described in our past editions. Q1 2022 will be remembered for being the pivot quarter in financial markets for many reasons. Nevertheless, the prospect of geopolitical de-escalation, the ongoing first FOMC rate hike and significant policy support from China will hopefully give the markets room to breathe, even if it's only by reducing the uncertainty. In terms of performance of EM assets, this is following divergences in EM fundamentals, which will likely to widen further broadly along the lines of each country's net commodity exposure and policy responses. EM inflation looks set to stay higher for longer with upward pressure, most intense in EMEA and LATAM, but Asia is also catching up on surging energy prices. Overall, risks to EM remain considerable. High food and energy prices require a fiscal response to mitigate the cost of living crisis. The challenge for many EM economies is that the strong fiscal response to COVID left many governments with limited fiscal room to address the subsequent crisis. Finally, we believe EM countries with limited fiscal space like Argentina, Egypt, Pakistan, or Sri Lanka, just to mention a few, are currently the most at risk while looking at broader macro resilience, of course including the fiscal space. We find that while Saudi Arabia and Peru stand out for the fiscal resilience, we prefer lower tier investment grade. Financial markets may recover, but the gap between the have and the have-not will grow wider, and that's the reason we deploy selectively and cautiously, constantly assessing the progress and resilience of our investees.
The global economy faces inflation, monetary policy normalization, demand destruction from high commodity prices, and a lack of fiscal buffers to support the most exposed nations to the surge in energy and food costs. We continue to remain overweight on global equities as they act and as an inflation hedge in the current environment and provides a strong alternative to cash and bonds, both of which are providing negative real yields. In the equity space, we maintain a slight value and cyclical tilt by overweighting energy, materials, financials, industrials, travel and tourism sectors. In addition to major exposure to high dividend yield names. For our fixed income exposure, we have been generally flying back to quality on the back of rising geopolitical risks, out of control inflation, and subdued growth. We are very selective when it comes to emerging markets, as many of the countries will come under significant pressure due to high food inflation.
As pointed out by my colleague Thomas, the macro backdrop remains challenging and we expect the global equity market volatility to remain elevated. The US Treasury yield curve hovering between inversion and reversion is also not helping to get a clear market signal. As a result, we believe a proper bottom-up analysis is important to own companies with strong pricing power, solid balance sheets, and low leverage to protect from market volatility. Although growth prospects have been downgraded over the past month, we still see supports from strong labor markets, healthy consumer and corporate balance sheets, and easing policy in China. In our global equities, we maintain a slight value and cyclical tilt by overweighting energy, materials, financials, travel and tourism sectors. We avoid long-duration technology names despite sizable drops from their 52-week highs. However, we have started to increase allocation to quality tech, generating strong cash flows and high dividend yield names. We see a well-diversified portfolio with a dividend yield cushion to be better equipped to withstand elevated market volatility. We also keep a sizable cash buffer to ride through the expected volatility and to opportunistically add to oversold names. We remain overweight on US but play through cyclicals and quality tech. We remain underweight on Europe as it would witness a much faster economic growth slowdown versus US tied to tight energy supply. We maintain our neutral view on EM as monetary tightening by DM central banks would create a liquidity squeeze and pressure EM currencies. Within EM, we prefer a tilt towards commodity exporting countries in GCC and LATAM countries such as Brazil and Chile, and Asian countries with relatively better managed fiscal and current accounts such as China, Malaysia, and Indonesia. In the MENAP portfolios defined as MENA, Turkey, and Pakistan, we continue to remain overweight on GCC equities despite them being up 16% year to date, given strong macro backdrop tied to high energy prices and push towards economic diversification. We avoid Egypt, Turkey, and Pakistan on low foreign reserves, high inflation concerns, and stretched current and fiscal accounts. Given the start of a rate hiking cycle, we continue to like an exposure to banks that will gain from net interest margin expansion on future rate hikes, declining cost of risk, and rising loan growth expectations due to a strong macro backdrop. We prefer regional top banks such as ADCB, DIB, SNB, Saudi British Bank, Riyadh Bank, Qatar National Bank, and NBK. In materials and industrials, we like regional companies which are exposed to urea, phosphate, and aluminium, as these commodities are gaining from global supply side issues on elevated gas prices. We also prefer reopening names such as MR Properties, Sira, Air Arabia, and Jazeera Airways. We are fully invested in our MENA portfolios.
Thank you for taking the time and watching another edition of A Chat with Daman Asset Management Team. You can always contact us on our website and social media platforms. Till the next edition.